For more, we're now joined by Paul Brashier, the Vice President of Drayage and Intermodal at ITS Logistics. Paul, thank you very much for being here. Drayage and intermodal, that's trucks and stuff that's all besides trucks, shipping containers all over the place. What is the view right now about just how impactful these attacks in the Red Sea could be to upsetting the entire global supply chain? Are we due to have another COVID supply shock like we did over the last couple of years?
Well, it will be problematic, Dom. Right now, you're seeing and reporting on the spot market rates increasing for the freight that's being rerouted from Asia to the U.S. Via the Suez. That spot market pricing you're reporting on now will be impactful, but you're also going to see charges that'll be passed on to the shippers and ultimately a consumer as soon as force majeure provisions in these contracts get triggered. So the additional cost to move these under contract will go up, and to avoid the distance that someone's going to have to go via the Cape of Good Hope, you have a lot of shippers now that are utilizing trans-Pacific routes from Asia to the U.S. West Coast, and those all have to float under the spot market. And those rates in 2023 under contract were $1,000 to $1,200. And as recent as 48 hours ago, those have gone up to almost $3,000.
Paul, I'm glad that you brought that up, because that's one of the big questions that I had. It seemed, maybe intuitive for a lay person like myself that if you're trying to ship goods from Asia to the U.S., say, for example, that you don't necessarily have to go through the Indian Ocean, the Atlantic Ocean, through the Suez, the Mediterranean. You could just go across the Pacific. Distance-wise, logistics-wise, and everything else, is that the better way to go if you're doing something intermodal, right, where the containers go from China across by boat to the Pacific, but then they're going to the West Coast ports as opposed to the East Coast ports? Take us through what all that looks like economically.
So those are going to have to be booked in the spot market. So you're going to see rates increase drastically as more freight gets moved over into those trade lanes. Now, once that freight does get to the U.S. West Coast, it's going to have to then either be moved inland via truck or rail further east, or to locations in the greater port region that they come into. 2023 underutilized all of the West Coast. So there's a lot of underutilized equipment and operations that could see a huge swell in volume and demand. And that could cause what we saw post-pandemic, just from congestion, additional fees, charges, and et cetera. So that inflationary pressure on just the ocean rates is going to be there. You will have inflationary pressure if a lot of freight comes over in a huge wave going into the U.S. West Coast, and having almost this groupthink situation where almost 2 weeks worth of freight comes in all at once. Now we're having to scramble to get that moved inland, and we're advising our clients to not join that train wreck, right? Get ahead of it and find some other routes via the Gulf of Mexico, Panama Canal, and the East Coast to make sure that they don't join any huge congestion issues that we might see.